Good evening. Today is Monday, May 10th, 2010. This is Brian Shannon from alphatrends.net, and we've had quite an interesting couple weeks here in the market. We were watching on the S&P 500 the Fibonacci retracement of the 2007 high to the 2009 low, and noting that we were at that two-thirds or just very close to that two-thirds retracement, 61.8%. For you Fibonacci fans, and that's also the location of the prior support where the market really broke hard from in September, October of 2008. So we were looking at this area not as a reason to sell, but as a reason to be very cautious going forward. We were noting that we were still clearly in an uptrend with the market above its rising moving averages, but based on the fact that the market was showing such an extended period of advancing here, that we needed to be extra cautious. Now, looking at this market in particular, over the last about year or so, you can see how the market just ground higher back in January. A lot of people were real quick to call it the top, and as it broke down and experienced a pretty strong correction down to the 30-week or 150-day moving average, it survived that test and then launched higher from there. Now we've had a test of the 200-day moving average. We're looking at this chart. That's 40 weeks. 5 days in a week would be a 40-week moving average. 40-week moving average would be a 200-day moving average. So if you look at this period from this line forward, it actually looks very similar to this period back here from 2006 to right about here in 2007. In other words, we had this sustained uptrend that we've just seen right here in the last half of 2009, and then a sharp break down to the 30-week moving average, and a lot of people called that the end of the move. It got a lot of people nervous, got their attention. Then a run to new highs that a lot of people were saying, just like this one, it's up too much, it can't continue, etc. And then a strong break down to the 200-day moving average. Now, there's no telling that the market, there's no blueprint for what's going to happen in the market, but it certainly gives us reason to take attention. The market doesn't generally reverse all at once. The top isn't, the A top or the V bottom aren't all that common. Instead, what we look for is what's the direction of the 40-week or 200-day moving average. Well, that 200-day moving average, let me clear this up a little bit, is declining. We look at the longer-term trend of the market as guilty till proven innocent. As the market is above and the 200-day moving average is advancing, innocent till proven guilty. When we start to see, same over here, when we start to see the moving averages begin to cross back and forth, it represents indecision and possible distribution. So that's what we're going to be looking for going forward. On a nearer term basis, we survived a hell of a sell-off this last Thursday, and have subsequently bounced very strong. Now, if you look, it's pretty interesting. I'm not a big Fibonacci guy, but if you take a look at this year's low to the high just recently seen, you can see last Friday we closed right on that low, and we've subsequently today bounced very strongly from that. Now, the big level of potential resistance for this market is really that 108.50 level. That's the level we were looking at as being tested numerous times on heavy volume on these sell-off days over the last month and a half, and the break below that is what we were talking about to get very defensive. Now we're starting to approach that level again on lighter volume than what we declined on. Now, we could still potentially continue up towards that 118.50 rather level, and we might even break back up through that level. However, it's still near term really a very aggressive trader's market. In order to have participated realistically in today's gains, you had to be a buyer on Friday. And on Friday, with the market below a declining 5-day moving average, the odds just didn't favor this type of move. Doesn't mean you couldn't have made risk, but with you couldn't have made a profit rather. But with a big profit like that overnight comes a lot of risk. So going forward, I think that we're going to see this market perhaps pull back. I mean, we want to see it hold probably about 114, 113.50. If it can do that this week, I think that we're going to see a little bit of that. Might call it a success for the week at least. But we've got that bigger level up near 118.50. That if it can get up through that level, that will really impress me more than anything. Now, what we want to look at real quickly is the volume weighted average price since the event. The event occurred 3 days ago. So we want to look at a 3-day chart and say, what's the average price the S&P 500 traded at over the last 3 days? Well, that's what this gold line represents. The volume weighted average price of this move is 113.44. So on average, over the last 3 days, anyone who purchased is in a winning position. Over the last 5 days, they were in a winning position. So the market is recovering, it's stabilizing, it's really still in a very precarious position here, and I think all but the most aggressive traders should continue to probably take a much more defensive posture towards this market, let things settle in a little bit, and let's see which stocks hold up the best. Go after those as they set up properly, but right now it's really a short-term trader's market, and even for the short-term traders on a day like today where the S&P 500 traded within a range of $1.40 or about 1%, there's just not a whole lot of opportunity, and cash can be a very good position sometimes, and that's something you need to consider.